Welcome to Private Capital Call. I'm your host, Randy Schwimmer. Today's guest is noted economist Dr. Mickey Levy. He's a visiting scholar of the Hoover Institution at Stanford University and a longstanding member of the Shadow Open Market Committee. And Mickey, it's great to have you with us.
Pleasure to be here, Randy.
So your timing of this conversation with me is fantastic because, on I think a positive note, it feels like the U.S. economy has been very resilient, and it also feels like we're actually achieving what a lot of people didn't think would happen, which heading towards some sort of slowing and soft landing. You've put out a lot of fascinating work over the years, and particularly recently, that the economy probably is likely not to go into a recession, and was curious, and I think our investors are curious as well, what kind of factors stand out to you to support that view of a slowdown and probably less likelihood of a serious recession?
So right now, businesses are very well positioned. Unlike prior mature stages of expansion, they don't have large overhangs in labor or inventories, and they have record-breaking cash flows. And so without these overhangs, they're not going to need to cut either labor or production aggressively. They won't need to clean house, so to speak. And as a consequence, real or inflation-adjusted disposable income, which is the key factor driving consumer spending, continues to rise. So what we can expect here is businesses to slow down employment gains, but without the serious overhang of labor, they're not going to need to cut significantly. And then you have other factors, Randy, that are really quite fascinating. Even though consumers' liquidity savings has been reduced post-pandemic, household net worth, which includes all the value of stocks, bonds, real estate, net of all debt, is at an all-time high of $155 trillion. And this is still flowing into the economy.
And that's flowing in how?
Well, people are borrowing against their houses to spend money. Older people are, required to take out, draw down a certain amount of their pensions. People spend some of their stock market appreciation. It's just constantly flowing into the economy, and we shouldn't lose sight of the fact that the U.S. is a very, very wealthy economy, and it is flowing in. Now, most people don't acknowledge to date is that business investment, which is typically one of the big swing factors in recessions, is far less cyclical as it has been historically, since there's been a dramatic increase in business investment in software and research and development. Those two constitute over 40% of all business investment now. And these two sectors, that is business spending on software and R&D, are not that cyclical. They barely declined during the sharp recession of 2008-9, and during the pandemic sharp decline, they continued to grow rapidly. So this will provide a buffer against declines in business investment. And then at the same time, we shouldn't lose track of the government's fiscal stimulus in the form of its infrastructure investment. Over $100 billion a year is going to be pouring into the economy, and also the incentives through the CHIPS and other tax credits that are boosting business investment in building facilities for semiconductors and battery plants and the like. So it all adds up to, by far the highest probability is a soft landing, or if we have a recession, it's going to be so minor, you can't even identify it except for those who scrutinize the numbers closely. And so this is quite positive for the economy and for credit markets and everything.
So if you think about, because obviously behind this is the battle that the Fed has been waging since November of 21, when they announced that they were going to start the following March, and they started to raise rates. And for a while there, it felt like they were behind the curve in getting that done, but they did some very aggressive, 75 basis points per hike raising, and They then got to the point where, close to an all-time high for the Fed funds rate at 5.5%. It feels like inflation, certainly in a lot of the indicators and a lot of the data that you've shared with your subscribers, that prices have come down across the board in a number of areas, still some stickiness in some areas. But it sounds like from what you're saying that there's probably still some buoyancy in the economy and probably, I would guess, in prices of some kinds of commodities and things like that. What do you think that inflation is going to be continuing to go down in somewhat of a straight line? There's clearly some price pressures which are different than others. There's the core inflation and all that. Could you talk to our investors and friends of Private Capital Call about how does one distinguish between kind of inflation that is positive based on the growth of the economy and inflation that's a little more corrosive?
Okay, so let's start at the beginning. That is 2020. There was excessive fiscal stimulus in the form of $5 trillion extra in deficit spending. The Fed accommodated it by moving interest rates to zero and then its massive asset purchases. And this created excess demand relative to productive capacity, and there were supply shortages and bottlenecks. And this created this big jump in inflation. Okay, the Fed fell behind the curve dramatically by keeping rates at zero for too long. And so the real or inflation adjusted rate on policy became the lowest negative of all time. So the Fed was way, way, way behind. So the cost of borrowing was close to zero. Then in 2022, the Fed caught up dramatically. And it raised rates from spring of 2022, through late summer of 2023 from 0 to 5.5%. Now, as the Fed raised rates, it slowed aggregate demand and the rate of inflation started to subside. But here, Randy, I want to make a critical distinction. While the rate of inflation is coming down, the level of prices of food, energy, shelter, they're dramatically higher than before the financial crisis. And while financial markets are focusing on inflation coming down, households are facing sticker shock with the high prices. And you see this in opinion polls and the like. But getting back to what's at hand right now is with the federal funds rate at 5.5, which is keeping short-term borrowing costs so high, that's way above inflation. So as inflation recedes, the real federal funds rate is rising. And the Fed acknowledges that as inflation drifts down further, the Fed does not want the real funds rate to go too high because then it could become inadvertently tight on monetary policy, which could lead to a recession. So what we can expect, certainly in 2024, the Fed is going to lower short-term interest rates to align it with the decline in inflation. Now, the decline in inflation, it has been fairly significant. My read is core inflation, that is excluding food and energy, will remain fairly sticky.
And what level do you think?
So right now, excluding food and energy, the core PCE price index inflation is 3.7. The CPI is a touch lower. I think it'll drift lower. I do not expect it's going to come back to 2%. But keep in mind, even as we talk about inflation coming down, that means prices are still going up, but at a slower pace. But the short-term funding, the Fed's policy rate that's going to determine short-term funding costs, that should be receding throughout 2024. So if we put that together with our assessment of the economy slowing but not going into a traditional recession, but the cost of funding coming down, it still looks favorable for financial stability and the ongoing health of business lending.
So I think that the Fed came out, Chair Powell maybe was the one who said it yesterday, that we're still not at the point, I think was his general view, that where we see inflation at the point where we're going to start cutting rates. I think that was somewhat the message yesterday.
That was the message from several Fed members. And keep in mind, without publicly acknowledging it, the Fed knows it made mistakes and it knows it misread the economy and inflation, and it's going to purposely keep rates high to make sure that inflation continues to come down further Because as you asked me earlier, will inflation fall on a smooth path?
Right.
Nobody knows. And the Fed doesn't want to run the risk of it bouncing back up, even if it's temporary. So the Fed is basically saying it's too early now to start talking about cutting rates. They're also saying it's appropriate to keep rates where they are. But as you and I know, financial markets are already starting to speculate about when will the
Right.
Fed cut rates, and that in and of itself is starting to bring down short-term funding costs.
And what can we look at as an indicator that would give us a clue as to when they're going to think about cutting rates? So what are they looking at? But also we can follow along and say, it's too early, because there are some calls that it's going to be potentially as early as the end of the first quarter that's going to happen. But what are they looking at?
Okay, certainly they're looking at inflation, but
That's core excluding food and energy.
that's core excluding food and energy. But as Fed Governor Chris Waller stated yesterday, they're not just looking at the year-over-year change in the core PCE price index. They're looking at the 3-month annualized, which shows that inflation is trending down. Now, beyond inflation, the Fed is scrutinizing employment data, and we get an employment number next Friday. Will it show slower employment gains? Probably. They'll look at other labor market indicators like the quits rate, labor force participation rates, and then they'll be looking at real data like what's happening to retail sales and consumption. And then the Fed has access to a tremendous amount of anecdotal evidence from around their 12 Federal Reserve Bank districts, and they'll add it all up. And then you have to listen carefully and know which Fed member's speaking, but the language, they will give forward guidance to the markets about when they'll cut. I think first quarter is too early to expect a Fed rate cut, but it'll come this year. And once again,
in 24.
Yes. And maybe they'll be lucky, end out with, a very nice soft landing after having made some real egregious errors in 2021 and 2022.
Yeah. So if you think about how we got to the 5.5%, it's unlikely that we're going to follow the same path back down, right? Because they have the opportunity to lower rates slowly. And if you think about being at 5.5%, if you go 25 basis points cuts, which I would think would be the first cut, unless the economy dramatically softens, right? You're only down to 5.25, 5.25. Do you think that they would potentially start early enough so that if inflation continues to come down, they're not forced to drop it too quickly, like to drop by 50 or even worse, 75 basis points? How do they pace the down slope of this?
It'll be somewhat data-driven, but I'd say the highest probability is it will be much more gradual than their rate hikes. Keep in mind, once again, when they kept rates at zero as inflation soared, they had the lowest or the largest negative rate in history.
Right.
They don't have that now. If you look historically, it's quite normal for the funds rate to be modestly above inflation. So they've normalized in the right direction, and now they just need to adjust it as inflation comes down. And while inflation has come down quite dramatically from its peak, a lot of that has been the food and energy components. And from now on, looking forward, we should expect the further decline in inflation to be much more gradual, and the Fed knows it only needs to reduce rates gradually. Now, what would lead them to move more aggressively?
Yes.
It would be if the economic data, and in particular, the employment data, really head south. That is, keep in mind, the Fed's has this dual mandate that is this interpretation of the Congress's
Full
Employment
Employment
Act. So they will be looking ever so closely at the objectives of the dual mandate, that is inflation and how it's doing relative to its objective and maximum employment. If we were to start seeing a material rise in the unemployment rate,
Then
they would move more quickly.
So behind this is obviously your expectation of where interest rates themselves are going to go, and we have a lot of investors listening in on this, what is your sense for, because the yield curve has been negative for quite a while, and that has historically been an indicator for a recession. Seems like now what's going to happen is there's going to be a reversal of that. Where do you predict interest rates to be next year, and how do we get there?
Okay, Randy, with regard to the yield curve, let's take the spread between, say, 10-year Treasury bond yields and 2-year Treasury notes. That was inverted as the Fed raised rates aggressively, and so short rates moved up way more than long rates. Why did the yield curve inversion not lead to recession? Because for so long, monetary policy wasn't tight. The Fed was raising rates, but the real federal funds rate was still negative. Now, let's put it in the following context. Since 2021, we've had bond yields normalize. So after being really low and way below inflation and inflationary expectations, now you have a positive real bond yield.
Mm-hmm.
Now let's consider the normalization of the funds rate. It's normalized, so you have a positive real funds rate. The next thing to normalize will be the shape of the yield curve, and it will occur by short rates coming down while bond yields are not going to move that much, because if you think about the current situation where you have a 10-year bond yield, a touch shy of 4.5%, with inflationary expectations of about 2.5%, that gives you an ex-ante real rate of about 2%, which is about its historic norm.
Okay.
So look for the yield curve to go back to positive. That's the third stage of the normalization.
Okay. And it feels like short-term rates have started to come down already.
That's right.
In anticipation of the Fed at some point next year dropping rates.
Yes, you just captured it very well by using the word in anticipation of, but we're at the early stages, and it's going to move along as we enter 2024.
And one of the things that I've noted in a number of conferences that I've been in is the fact that the period from 2010 to 2022 was an artificial environment relative to history, and you're a student of economic history, because the Fed was continually flooding the market and the financial system with liquidity because they kept worrying about what just happened with the Great Recession, and they didn't want it to happen again, and that we saw that in spades during COVID. And we saw it in a number of situations where there was somebody thought, hey, let's start to raise rates because things are getting heated up. And then something would happen and no, let's reduce rates again. So the environment we're in now, higher for longer, is probably more normal historically than what we saw during that period. So I think my sense, I'd love to hear your view, is that the next 10 years could probably see higher inflation and higher rates in general than we saw in that 2010 to 2022 period.
I think that's right. One way to characterize things is this new normal with positive inflation-adjusted short rates and long rates is very similar to the old normal before the financial crisis. In between, from the financial crisis through the expansion that followed, particularly the first 4 years of the expansion, that was the abnormal period. Remember back in 2009, 10, 11, 12, where the Fed kept rates at zero and they did their quantitative easing. But the reason why inflation stayed low then is all of their stimulus really didn't generate a surge in aggregate demand that would generate the higher inflation. So what happened differently during the pandemic? Well, in contrast to the financial crisis period and a few years after, then household balance sheets were crippled. The financial crisis really was a crisis, and it took a long time to work our way out from under that, to households and banks replenish their balance sheets. And so the economy didn't, inflation was below the Fed's 2% target. Now, post-financial crisis, household balance sheets remain in good shape, and fiscal stimulus wrote checks to everybody, multiple checks, and generated huge savings. Banks had their high capital ratios. So the economy is in much better shape. So in response to the monetary and fiscal stimulus in response to the financial crisis, you did get this surge in demand. Now, looking forward, I agree with you. I think the underlying rate of inflation is not going to go back to sub 2%. I'd say it's going to be 2.5 to 3. That would be my ballpark of a number. And I also think real or inflation adjusted rates will be positive. That would be just fine and would provide a stable environment for financial markets and for, more importantly, continued economic growth.
So just lastly, Mickey, when you look ahead over the next short-term future, we have a lot of global investors on this call. You've done plenty of reporting on the global economies. I've done a lot of travel this year to a number of countries and sort of seen both the perspective on the U.S. from outside the country and then also comparing it to some of the other economies in Europe and Germany that are struggling a bit because of the nature of their economic base. Maybe in a few words, what's the outlook for the U.S.? Are you optimistic about the outlook, our competitive stance, and the way that our economy is constructed for the long run?
I'm definitely optimistic. And the way I would add things up from an economic perspective is the U.S. has the highest potential growth rate among all advanced economies in the world. That is, if we consider potential sustainable growth in inflation-adjusted terms, the U.S. is probably double Europe's. It's higher than the UK's. It's higher than Japan's. So let me make the following observation. We all know policymakers in Washington, D.C. are not addressing the issues they need to address. And there's a lot of problems with our policymaking and our policies. However, if you look at the private sector, the pace of technological innovation in the U.S. in a wide array of industries and sectors is just absolutely stunning. And we're generations ahead of the rest of the world in our innovations. And the pace of implementing these innovations into commerce and society are equally efficient. And then if you stand back and say, in addition to that, the U.S. has had a history of being resilient and resourceful. And this is what drives economic growth. Do we need immigration reform? Absolutely. But the U.S. population continues to grow. I think we're going to get a lot of immigrants and the U.S., despite its problems, is very good at assimilating immigrants into the workforce and into society. And then there's the productivity that's driven by innovations that we read about every day in the paper. So while I don't approve of the thrust of economic policy making, I believe the U.S.'s favorable characteristics will lead it forward. And so I remain positive.
Mickey Levy, the visiting scholar at Stanford's Hoover Institution, long-standing member of the Shadow Open Market Committee and former chief economist at the Bank of America and good friend of ours. Thank you so much for being on Private Capital Call.
Thank you.
And we'll we'll publish a lot of Mickey's charts and graphs that he comes out with, which are tremendous. And we'll publish those in the lead left and on our LinkedIn Private Capital Call site. So thanks for providing all that great information.